So, last week we talked a lot about candles, what they represent, and how markets move in the futures market. So, now we are going to zoom out a little bit and then look at the larger story that the candles are telling us. So, we know that every move in the market, it either goes up or it goes down. So, the market, as it goes up and goes down, it follows a rhythm. And sometimes that rhythm will continue in a particular direction, and then sometimes it'll shift in an opposite direction. So, today's goal, we are going to learn how to recognize when these shifts happen, when buyers are strong or when sellers are strong, and how to spot when those transitions happen early. So, my hope for us is that by the end of this session, we'll understand what it means when the market is trending, when it's retracing, and how to prepare for an actual reversal. So we'll look at some examples and then we will identify a couple of cause and effect moments, some if then statements to help us to navigate in the upcoming week in the markets. So next slide, here's a quick overview. So just following up, picking up where we left off with the candles, storytelling, getting into market structure. I'll go over some very specific anchors on the charts. And then we'll talk about accumulation, manipulation, and distribution, which is very important when it comes to price delivery. And then how we can connect that with sessions. There are three: Asia, London, and New York, as well as execution frameworks. And I'm going to focus on two setups, like I said previously: reversal and continuation setups. And then if we have time, focus on risk management and reflect and go from there. Alrighty, so candle behaviors. We left off on the last session with the introduction to candles, and we will use that knowledge to read candles in sequences, not just isolation, individual candles. So momentum forms from consecutive conviction candles, and then hesitation forms when the bodies shrink or overlap. And this is going to help us to see when price is most likely losing energy or when it's gaining momentum. Alrighty. Keep going since we went over this already. Alrighty, market structure. As I stated in my introduction, every market is going to move in either one or two directions. It's either going to go up or it's going to go down. I guess I could say a third one, which is ranging, where it just goes back and forth in a consolidation motion. And so we're going to identify the one of the two of those rhythms. All right. So market structure, trend versus counter trend. So a trend is when the market is moving with strength in a particular direction. So we either have higher highs and higher lows for a buy trend, or we have lower highs and lower lows in a sell trend. And so a counter trend would be a pause. So we have a temporary pullback as prices continue to go in a particular direction. So this is not a reversal. It's just the market taking a breath and continuing. So with counter trend, we have a temporary move against the main move. So prices going up, higher highs, higher lows. When price makes that lower point in the market, that's just a pullback. Some people like to counter trend. I don't recommend that, but we're going to talk about how to identify the difference in later slides. And so these are important because, and it matters because it keeps you aligned and focusing on the trend. You guys might have heard this before. The trend is your friend. We're going to really try to focus on trading trend trades. Next, it helps you to time your entries. So oftentimes the counter trend moves and it leads back into the trend direction. And those retracements, which we're going to use Fibonacci later in this presentation, that's going to help us with our entry opportunities. And also, understanding structure helps you avoid traps. When you are recognizing that price is just simply pulling back and not turning all the way around, it helps you to not get stopped out too early or to enter in on the wrong side. All right, so next, the way to spot this is pretty simple, and I have examples in the next slide. Each new swing high is higher than the last. And then it respects the VWAP, which we'll talk about shortly, or the fib, which is the 50% of a range to the 61.8% of the range and continues upward. And then the same is in the opposite. So every new swing low is lower than the last one. And it's just the same thing in reverse. So you're going to continuously have higher highs, higher lows for a bullish trend going up, or lower lows and lower highs for a bearish trend going down. And then the counter trend would just be the short-term pullback and it's very shallow. We'll talk about the percentage of that as well. And that helps to build liquidity, which is fuel for the market to continuously go in our desired direction. Are there any questions so far, ladies?
No.
Okay, awesome.
No.
Okay, so here is an example of a counter trend. I'm sorry, of a trend, and then when price could potentially reveal a counter trend. So looking at this chart, what direction is the market going overall? The largest move? Is it a bearish move or a bullish move?
Bearish.
Bearish, awesome. So anytime we see these blue candles, since bearish would be our red pink candles, anytime we see these blue candles, even if they look like they have a lot of momentum, what would we characterize that as? A counter trend or a regular trend? Or trending, excuse me.
I'm sorry, can you say that again? My volume went out.
No problem. I would say when we see, since we're in a bearish momentum, every time we see possibly a spike of blue candles, how will we identify that as a trend or counter trend?
Oh, counter trend.
Counter trend. Awesome. Okay, cool. All right, we got that. I think that's pretty self-explanatory. So next aspect of market structure, excuse me, are shifts and breaks. All right, so structure is definitely the foundation of price action. Every high, every low builds the blueprint for the market and how it's going to move and how it just previously moved. So market structure breaks. So market structure break is a clear close beyond a major pivot point, confirming that control has shifted from one side to the other. So we use breaks to show us like price is continuing, it holds structure, and it's proving that the market is proving that we are in control in whatever direction that is. So an example, a bullish market is breaking the previous high. So a continuation is forming, it's confirmed. And in a bullish trend, breaking the previous low, that equals the continuation is confirmed as well. So for a market structure break, we have that equals continuation. And so for a market structure shift, in the inverse, this is when price violates the current trend structure. So it's breaking in a key swing in the opposite direction. So this is a violation that hints the current direction may be weakening. It's showing us that there might be a shift, maybe not necessarily a full reversal, but definitely some type of retracement at the least. So a market structure shift equals transition. So control shifts hands and the market is questioning whether or not the bulls are continuing or reversing, or the bears are continuing reversing, depending on where we are in the market. All right, so again, this is just a quick, what I just said over again. This will be in your slides. You don't have to worry about screenshotting it. That market structure breaks confirms that the trend is continuing, and a market structure shift shows that the trend may be reversing or we may have a pullback. All right, so here's a quick example of a market structure break. So on the bullish side, we have highs, then a higher low, then a higher high, then a higher low, higher high, higher low, then the previous high and low that came before it. And then on the bearish side, we have lower lows and lower highs. And then the lower low is lower than the previous low, and then the lower high is lower than the previous lower high. And then we have breaker structure that shows when that structure is literally broken. And then on the other side, we have market structure shifts. So we have a high, we have a low, lower high, lower low, continuing on until we get to a point of interest or a higher time frame interest point, and then price shifts. So we see that we no longer have a lower low. We're going to have a higher high that breaks from the previous lower high and then goes back, and then it does not break this lower low, and it continues to go in the opposite direction. So this is when we would have a shift. And of course, all of these things happen on all timelines, on all time frames. All right, so here's an example of MNQ that happened earlier this week. Quick question, if we are able to communicate. The market is doing what in this picture? So I'm going to Just give us some anchor points so then you can speak to what you're identifying. This is panel 1, panel 2, 3, 4, if you can see these sections, panel 5, panel 6, and then panel 7. So for the majority of this chart, who is in control, the buyers or the sellers?
Buyers.
Buyers, perfect. Did price confirm that there was going to be a continuation, or was there a shift that occurred in this screenshot?
A shift occurred.
The shift.
A shift. Can anybody identify where that shift could have possibly happened?
Is that the sixth panel? 1, 2,
Or is it the last one?
2,
Yeah.
3, 4, 5, 6. Yes, ma'am.
sixth panel. Okay.
So yes, it is in this one. This is where the shift occurred. And this is literally where the shift occurred, where this candle broke below all of these structure points, and then price retraced, and then we had a sell. So ideally, this is where we would enter, because we see that the price has shifted. We see that the story has shifted. Price broke below this previous low, which is on an hour time frame, which is considered a higher time frame. So that gives us extra confirmation that we can potentially go ahead and sell off. Price is also below this blue line, which we'll talk about next, which is the VWAP, which talks about volatility in price. And then price goes ahead and it sells. Lauren, yes, ma'am. I think I saw your hand.
I was just wondering, can anyone else see Bianca's cursor? I don't see it. I only see the chart for some reason. But if you're pointing to anything, I can't see it.
Oh, that's okay. And I'm glad you got, thank you for saying that. I thought that you could see it. And I'm glad that you guys were able, y'all figured out the 1, 2, 3. But anybody else can see it or not see it?
Say that again?
Can you see my cursor on the screen?
No.
Oh, interesting. Let me see if there is a way for me to do this. Oh, I can annotate here. Can you see that? I just made a mark.
Yeah.
Okay. I don't know if I'm going to use that because it's not a cursor and I don't want to. We're going to figure it out. I'm going to figure it out. But thank you for bringing that up, Lauren.
Sure.
Okay, so going. Okay, cool. Good job, ladies. So in our next example, what do we see in this chart? Is in control, the buyers or the sellers?
No one. It's a consolidating.
Yes, perfect. Beautiful language. Yes, it is consolidating. This is a very choppy market. Another way to identify that this is choppy is this blue line, which is the VWAP, is straight. And these sections represent actual trading days. So this went on from one day into the next. This is not ideal for us to trade because we don't really know where price is going. Some people might do a short scalp because, of course, if this is and I'm just writing and y'all can't see it, I'm sorry. If we were to even get into anything here, now with hindsight being 2020, it looks like it would be good for us to get into a buy, but it would be short-lived because of how it previously chopped. So you're absolutely right, Lauren. Great answer. And we will go into the next slide. Oh, let's skip something. Okay, so changes state of delivery. All right, so this is adding to the market structure shift, right? So momentum, this helps us to better identify momentum in the market. So we already talked about the trend showing who's in control. We talked about market structure breaks, which confirms that control continues. We talked about market structure shifts, which talk about how or signals how control may be changing. So in this next criteria, it is the change in state of delivery. And it describes the moment when market control visibly shifts hands. So when price stops delivering in one direction and begins delivering with aggression in the opposing direction. So with this concept, it bridges the gap between the liquidity sweep and as well as the market structure shift, what we just talked about. And we'll talk about the liquidity sweep also in more detail right after this. So once again, the change in state of delivery occurs immediately after a liquidity grab and then before or during a market structure shift. It's like the heartbeat of the market's intent. So in this example right here, oh, y'all can't see my cursor. All right, let's do this. Okay, so we see that price is moving bearish, and then prices, we have a, excuse me, a lower high, and then we have a lower low, and then price literally shifts. So right here, it breaks. It's broken the previous candle, bullish candle that created the sell down. It broke that, and then we would just be waiting for a retrace, and then we would continue to go higher. I feel like that is messy, but we're going to continue to talk about it in the next slides. So what is the most important thing that I want you all to grab from this is that this occurs after there is a liquidity grab / sweep. I'll use them interchangeably. And that usually happens at a previous high or low in structure. Ideally, we want that to happen from a previous high or low on a higher time frame. Any questions so far?
Yeah, can you break down liquidity grab?
Yes, ma'am, I am. It's going to be in the
Okay.
next slides after this.
Okay, got it.
But I will show you from here where we're looking at. Oh, and y'all still see that green on there?
Yeah.
Yeah.
Okay. All right, perfect. All right, so right here where we see these long wicks, these can be identified as liquidity grabs. They're literally going in one direction. So say, for example, for here, we are looking for a sell. Price is showing us lower lows and higher lows, but we don't have necessarily an entry yet. And then looking at this blue line, it's still straight. So we really don't have anything that's telling us to sell just as of yet. But price needed to grab something like liquidity in order to fuel it down. So here we see, and this is a trade that I actually did take. Here we see, oops. All right, so at that 9:30 candle, which is where the end of this black horizontal line is coming from, price closed and sold with displacement, and then it broke past the previous bodies of those candles that are to the left of it, that are still on that black line as well. And that was the change in the state of delivery. So after that, price, okay, because I don't see my cursor anymore. Okay, so this is where the change in the state of delivery happened. Price went back up to this blue line, which is the VWAP. It retraced, and then it continued to sell down. So when I say liquidity grab or liquidity sweep, price is reaching for a previous high or low. So in this example, it came back to previous structure that was here, and then that fueled the move down. Does that make sense for that example?
Yeah.
You said here? Where was here? Oh, I see that little dot.
When I say retrace,
Yes.
it went to this little dot. I'm sorry, it's difficult for me to use because it doesn't have a pointer. It just has a pin, a text box. It doesn't have a place to mark, which is so strange. So thank you so much for your patience. Maybe I can show better here. I don't know if that helps, but right there is where the place for price to retrace and then to continue to sell. All right, so
Okay.
let's go to our next example. All right. All right, so here, I'm sorry, ladies. All right, so this blue box right here represents the last, since we were selling from here, and then price showed bullish momentum, but we still don't have an entry. So this, it would be an anchor, which is an order block, and we'll talk about that in the very next section. Price would need to break above, literally to shift above here in order for us to possibly get in for a buy, right? So price continued to break. It was consolidating around this blue line or this blue box, this blue area. And then it came down to the VWAP, which is a very important anchor, but it didn't break below because since price is above it, we know that price still wants to probably potentially buy. So we're looking for an entry on the buy side, not the sell side. All right, so here price actually did break. with this candle. So we just waited for a retrace, price to come back here, and we got a perfect entry right here where price came and grabbed liquidity. And we have another structure here, another OB, as well as a fair value gap. I am so sorry, ladies. I didn't realize how much this slide had that I hadn't explained yet. So I apologize, and I probably will come back to this after I explain what an order block is, what a fair value gap is, what a VWAP is, and all of these different descriptors. Okay, because you probably, all right, y'all. I don't get it. Thank you for your patience. I'll come right back to it. All right, so here we go. All right, so acres, what I've been talking about, and y'all are like, what is happening? All right, so these are very essential to the execution structure. So the anchors, the 6 anchors that we're going to talk about are reference points that help us interpret what the market is actually doing, and they confirm whether the story is telling us that we are going to buy, sell, whether we are seeing any type of manipulation, whether price is trying to deceive us or try to fake us out and take price as liquidity, or if we actually have momentum going in our desired direction. So these markers are like, these anchors are like the market's language, and it tells us the intent. These are the ways that we're going to use confirmation for our trades and not just guessing. All right, so here are the 6. I'll give everybody the opportunity to read these. They're fair value gaps, which are imbalances in the market. And there's order blocks, which are the last opposing candle from a strong move, which I was just referring to in the other examples. And then we have liquidity sweeps, which are raids where price literally comes in and takes stop orders and collects liquidity to fuel price in the direction that it is intended. This is where a lot of retail traders, when you might see those double tops, double bottoms, head and shoulders, I'm trying to think of other patterns that we used to use, that I used to use, where price will come in, it seems, man, I was going in this right direction, and it's like price came, saw my order and took it, is because that's where people usually keep their stops, and that's what fuels the market to go in the desired direction. So liquidity sweeps are very crucial to what we're going to be doing on the charts. And then next we have previous highs and lows, previous sessions as well. Then we have the VWAP, which is the volume weighted average price. That is that blue line that I was showing you all. It might be a different color for your charts when you do it, but mine is blue, and it confirms bullish or bearish bias as it pertains to price and structure. And then Fibonacci is just the cherry on top, and it shows us where price it could potentially retrace for us to get into an optimal entry. All righty, ladies. I apologize for the noise in the background. My neighbor is doing something in his yard with those cars, so I apologize. I don't know if you guys can hear that. But for fair value gaps is where we're going to start. And this is where imbalance shows up in the market. It's an area where price moved too quickly, leaving inefficiencies, imbalance between consecutive candles. So this shows where inefficiencies are and where price is likely to return. All right, so price often returns to fill in these gaps before continuing in the original direction. And this retrace gives us low risk entries. Are there any questions on this part yet? All right, we got thumbs up. Okay, so this is used very well with Fibonacci. Fair value gaps usually occur inside the 50 to 78.6% of a retrace, and those are high probability entry zones, which we'll talk about in the upcoming slides. All right, so next are order blocks, and this might look a little grainy, but these are some examples of some good order blocks and some that are not order blocks. And what it is, the last opposing candle before a displacement move. And displacement just means a move with lots of volume, lots of momentum. So institutional footprints precede major /impulsive moves. An order block is the last candle before a momentum move that most likely will create a fair value gap as price moves in that direction. So there will be multiple order blocks. Say we're in a bearish market, there will be multiple places where price will show bullish candles, and those will be the order blocks that will proceed a continuous move down. So we might have a little order block, a bullish order block every now and then in a bearish move, and that can just show us where we might be able to retrace and get in for a sell. Order blocks are heavily tied to change in states of delivery as well as market structure break events. We combine the order block with the fair value gap as well as the VWAP for a high probability structure confirmation. All right, so these are like hidden support and resistance. We see that, and now y'all can't see this, I'm sorry. In this first example at the bottom, where price has a red bearish candle, there is a large green candle that breaks above it. This is going to be the classic break in structure that we would like to see, and also identifying that this is an order block. Price moved with momentum, creating a fair value gap, which is this horizontal gray line. And it's a likely place for price to return to in order for us to get an entry to continue to buy. Are there any questions on that so far? All right, so we'll keep going, and I have some more examples. I'll have some examples in the upcoming slides. All right, so previous highs and lows are literally the market's memory. So the previous high and low are extremes of previous price movement. So these act as reference points where buyers and sellers have last held control. So we can see these within previous sessions, previous days, and as well as intraday swing highs and lows, and they all serve the same purpose. These are smaller memory points where price pauses, reverse, or expands. So these levels are where liquidity gathers. These are the places in where price likes to go and grab liquidity and reverse in the opposite direction. Or at least this is an additional, these are good places for us to put our exits when it's time, when we're actually entered in a trade and we see that we have a high probability trade, we've entered in the market, we're active, and we're looking for a place to close. Of course, we would have already identified this before we got into the trade, but these are also good places for us to exit. And these are not just lines, they're the market's memory, and they also help us to identify the market's intent, liquidity targets, guide daily bias and sessions early, and then create intraday swing points, higher highs and higher lows. All right, so here is an example of a previous low. All right, so let me turn on my annotation. All right, so here we have this blue box right here is a fair value gap. So this was a high probability trade that I actually took earlier this week. Price came down to this low right here. This was a previous low on a swing, on an uptrend. Price came back down, broke into or swept the previous lows that were right here. That was also a 15-minute fair value gap. And then it continued to buy from there. So that shows just an example of how price goes back as a magnet to these anchors, which is also some of we just talked about. We have previous lows as well as a fair value gap. Price came down, and this is a sweep. This is literally what a liquidity sweep is. It could have tricked people to thinking that it was time to sell. It came down to this area and it continued to buy. Does that make sense, ladies? Or do we understand that concept at least?
Yes.
Okay, awesome. I'm trying to take the annotation off. Okay, cool. All right, so next, liquidity sweep. Liquidity sweep. This one is, for so many years, I did not understand this and had lost so much money because I just did not understand what was happening. Why would price come and take out my stop and go in the opposite direction? But this is going to save us a lot of money. So liquidity sweep happens when price moves beyond a well-known high or low. not to continue in that direction, but to trigger orders and to collect liquidity before reversing slash continuing with strength. So think of this as the market taking a deep breath before it moves, before its next move. It pushes into the area where traders have stop losses or breakout orders. It collects liquidity, which I want you to think of liquidity as fuel, and then delivers into the opposing direction or the opposite direction, excuse me, once those positions have been absorbed. So we always look we always look before a strong move to see if liquidity was taken. We are not entering in any trades unless liquidity has been taken. Because if liquidity has not been taken, 9 times out of 10, that means whatever trade that you're about to enter in is about to become the institution's liquidity. Right? So we want to focus on, as we're looking to see when liquidity is taken, we want to ask ourselves, who is it that got trapped? Did the buyers get trapped? Did the sellers get trapped? If we're looking for buys, we want to make sure that sellers got trapped. If we're looking for sells, we want to make sure that buyers got trapped. That is where our opportunity rests. These liquidity sweeps push price into those areas to trigger both. All right. So sometimes liquidity can be taken from one side and it's filling their orders on the other side. And when I say their orders, the actual institutions. So the reason why this is important and why it matters, it reveals who's in control, the buyers or the sellers. It shows where real money enters. And I mean like the millions and billions of dollars from these institutional banks, hedge funds, and things of the. It helps to avoid traps. It creates the fuel for the next move. Displacement is the delivery. And once again, displacement is where we see those large candles that are going in a particular direction with a lot of volume and a lot of speed. And it also anchors our high probability entry zones. So this is where OBs, order blocks, fair value gaps, fibs, and the VWAP align. All right, so here, this is an example. I believe this is the last FOMC, which might have been maybe 2 or 3 weeks ago. Price was buying. Let me see if I can annotate here too. Price was buying. Ladies, can you see my mark, my pen?
No, yeah, we can now.
Okay, perfect. So price was buying. We see higher highs, lower lows, higher highs, higher lows, higher highs, higher lows. Price is going up, and then there is a sharp move down. Now, in real time, price is moving so fast, you may or may not know where it's going because that wasn't anticipated. But because this was a market manipulation during red folder news when Jerome Powell spoke, price shot down and came to this. Whenever you see this blue box, for me, that is a 15-minute fair value gap. I'll show you guys what my key is when I identify certain things on my charts, but that's what I use as far as a 15-minute fair value gap. It is, I would say 80% of my trades come from there. Now, granted, there are fair value gaps on all time frames. However, the bread and butter is literally at the 15 minutes. So you might have a 4-hour, but if there's also a 15-minute fair value gap there, that's extra confirmation that price wants to do something. Either it wants to continue or it wants to take that liquidity and reverse. So here in this example, as I was saying, price was continuing to go up. It came down, bounced here off of this fair value gap, and then it continued to buy up. So that was legitimately a liquidity sweep. Price took out all of these people who were buying, just to get a little bit more liquidity and to continue to buy. Any questions so far, ladies? That might have been a little meaty. Okay, perfect. Awesome. Okay, so next is the VWAP. And the VWAP is the volume weighted average price. So essentially, this is the true price or the true average or the mean of price institutions. Essentially, the true average price institutions. Institutional mean the price is used for rebalancing. So this is how we can now establish smart money, which are the institutions. This is how they identify fairness as well as volatility. So it's important because it shows institutional bias, especially on the higher time frame. So if price is above that blue line that I have on my charts, if it's above the VWAP, then price is setting a bullish tone and buyers are in control. If price is below the VWAP, then there's a bearish tone and sellers are in control. It also acts as a dynamic support and resistance. And I say dynamic because it moves throughout the day. Of course, as price is moving and there's price action, the actual volume is going to shift and the weight of price is going to shift literally on the chart. And it also confirms delivery, whether price is accepting or rejecting value. And that's when the markets, these larger institutions put money into the market, and it shows us whether we're on the right side or not. And next is Fibonacci. All right, so Fibonacci retracement, it measures how deep price pulls back during a move. So say we are in a bullish market and we're looking for buys with higher highs and higher lows, but then we'll look for a retrace to a 50% of that in between that higher high and that higher low and higher high. And it represents a natural breathing point for the market. So we know the market can consistently go up and up or lower and lower without some type of a pause for liquidity before a continuous impulse move. So these are used after an impulse move to identify where price may rebalance before it's continuing. We use this as a measurement of proportion and rhythm, and it helps us to develop a better eye for entries. So it confirms continuation or reversal. It creates an entry precision, as I just stated, and then it also defines targets, and it helps us to identify our risk as well. All right, so for this next slide, I actually showed this example earlier, and this is where price, there was this, and I'm just pointing, y'all can't see. This is where that OB, where this blue box is, the 15-minute OB, as well as a level 4 that the sellers could not break down and then the buyers could not break past until we got to where the actual Fibonacci is. Now, if you can see this scale that has the multicolored lines, we see that price was drawn, the Fibonacci was drawn from the low to the high. And let me go ahead and annotate this. So price was drawn from this low to this high, and it was drawn to this high because this is where price had actually broken past this OB, this previous structure. So once price had broken past that structure, we were looking for a retracement, and price came right into that 50%, which is right here. And there's also a 15-minute fair value gap right there. Price was also above the VWAP. This was an A+ setup. Price bought not only to this first take profit, which on my chart is a 0.27 or negative 0.27, and then take profit 2, which is a negative 0.61. So you can use fibs, as I stated, you can use it not just for entry, but also for exits as well. And then right here, this little tool right here, it just shows the risk to reward. I didn't want to put it on top of the actual candles because it gets a little messy, but it shows that this trade had a risk to reward of 3.25 to 1. The stop was 46.5 points. That was risk in order to gain 151 points. So it had a pretty good risk to reward with it, and it was an A+ trade. Any questions, ladies? All righty, so we'll keep moving. All right, Fibonacci's. It can be intense. And sometimes I know for me personally, I used to use them for everything, even when there wasn't anything to really identify. So from some of the main ways that Fibonacci's cannot work are when you don't have, when you're lacking structural confirmation. So price, there might not have been a change in the state of delivery. There might not have been a structure break. If there isn't, then there's no place for you to draw a high and a low. So then a Fibonacci wouldn't work there. It also wouldn't work in sideways or choppy ranging markets. If there is no trend to show us a higher high and higher low, or a lower low and a lower high, then there's no place to really mark where a fib can start and where it can end. Thirdly, missing liquidity sweep before a move. If there was no liquidity, 9 times out of 10, it's going to be coming. So you definitely want to wait for that to happen, because you don't want to draw a fib that is of full liquidity, because you don't really know where it's going, because that was price gaining its fuel. Now, sometimes, a lot of times, it will work once liquidity has already been taken and you can draw it and it's a part of it. But for it to be the actual high and low, it gets a little, I won't say that's 100% an issue. Sometimes it works, but most times it doesn't. I just wouldn't recommend doing it at all. And then number four, which we already talked about this, not drawing the high and the low at appropriate levels. So sometimes I think you might see a swing high and a swing low, but if the points are not accurate, especially after that liquidity sweep, then it's going to distort your view on what to mark as the starting point to the ending point. Alrighty. So trade that was taken from October 22nd into 23rd of this year. And this was in MNQ. And this is separate from the one that I had just been talking about. But I just like this one because it shows how all of the things just stacked on top of each other as far as the OBs and the fair value gap and the Fibonacci, right? So the order in which we want to look at this, because we're not going to look at for all confirmations at all times. We're just looking to see or evaluating which anchor overlaps. So confluence is going to be focused on stacking the logic. We definitely want to make sure that first, before anything, we have some type of liquidity sweep, right? We have a liquidity sweep, and then after that, we have a change in the state of delivery. And then after that, we're looking for where the VWAP is, where the fair value gap is, whether there is an OB, and then also to incorporate the fib. And that looks like a structure shift, looking for an entry, and then looking for price to continue to distribute. In full transparency, these are the trades that I took today. I got stopped out right here because I got in way too early and then came back. My goal was to break even, but I ended up taking negative $62 on the day, which I'll take that over a bigger loss. So help me to help you, Mickey. Where do we want to start? Show you how to use certain things, or
Just point out the different ones.
okay.
Like the market shift I got.
Okay.
The Fibonacci I got. Do the VWAP.
Okay. So right here, I'm really big on just being transparent. If I'm wrong, I don't have no problem with telling you I'm wrong. So I'm glad that you asked me that, Mickey, so I can just show you what happened. Today, in my mind, first of all, I got up early, and I'm very big on not trading before I pray or before I read my word. And today I did neither. And I just feel, you know what, when you don't do what you're supposed to do, you got to pay the price. So when I woke up this morning, I saw price doing this. But in my mind, it was still about to sell. I saw this 15-minute fair value gap. And you see where price, you see why I drew that, Mickey?
Mm-hmm.
There was an imbalance here and it left space. And that was the gap. Price literally did come back and return to it. But before it even did that, I had already entered in for the sale. I didn't see this until after the fact because I was trading. Another thing that I highly don't recommend is from your phone. I had expected that since price had dropped with so much momentum, this bearish candle right here, that it was ready to go ahead and break below. And granted, it did. It gave a little bit of a sale early. Let me move this away because I already did my screenshots for the day. It did a little bit of a sale, but I did not see this until after the fact, until I got up and then actually got on the computer and saw, oh, this is the reason why price stopped me out and turned back around and bought. So we see how powerful the fair value gap is, because when it came to, even though volume was showing that it was ready to sell, there wasn't enough liquidity to take it lower. So it had to come back up and get something else. I don't see any additional fair value gaps here, but the reason why I was ready to sell also again is because this was the 930 price had already was ready to break with already increased with volume. It took out this previous high. The market opened at 930. I can take that out too because I already did my screenshots. The market opened at 930, and with so much volume, I went ahead and I entered at 25,000. I think it was 776 today. And I got out at 640. I didn't even take it all the way down that low. 600. I did not take it that low. It wasn't 40 anything. I think I was right here at 85. So I took price here And then when I saw it starting to retrace, I got out because I had already, let me verify. Hold on. Let me look at my screenshots. No, this is what happened. On this one right here, I let one contract continue to run and it turned around on me. And so that's where I got stopped out at. And I ended up losing $148, which brought me to a negative 62 for the day. And yeah, I was explaining that for a reason. I'm sorry. Did I answer your question, Mickey?
You're helping me once you're explaining it a little bit better. So yeah.
Okay. Okay. Yep. So that would be an ideal trade. Let me go back. This is the trade I took yesterday. Price was selling. We had bearish momentum, but it wasn't giving full volume. First of all, yesterday was Veterans Day, and I did not realize that it was a bank holiday. So I should not have been trading because all of my confluences didn't go in. The only thing that I was missing, the biggest thing I was missing was a 15-minute fair value gap. But once price had taken out this previous high that was made after London, I was more confident in the sell, especially with the VWAP being above price, letting me know that price wanted to continue to sell. So I hopped in, I guess that was 606, and I took price down to this next OB. I like to get base hits because every time I try to go a little bit too far, price turns back around on me. And as us being women who have other jobs, businesses, and things going on, I just highly recommend that you do the same. One, nobody wants to be on the charts all day long. And then two, it's just best for your sanity. Does that make sense?
Yeah.
Okay, awesome. All right. And okay, so let me go to another example. I think this is the one that I showed actually this is the one that I showed earlier in the screenshot. And then we can go to this one. And this will be the last one because we're at 7:25. All right. What day is this? This was last Friday. I went back too far. Last Friday. Did I take this trade? It was a 10th. I did. Okay. So price was moving super fast. Hold on. This was Friday the 7th. I don't think I have a, yes, I do. Okay. All right. So price here, we have the market open at 9:30. We have a fair value gap to the left. Price came down here. We have a bearish candle. Price gave a little bit of momentum there. We see that price refused to break back above it. So it's confirming the VWAP with price being above it. And I'm sorry, with the VWAP being above it and price being below it. And this happened pre-market. So we wouldn't necessarily enter here. But if you did, it still is in confluence. Some people wait until actual 9:30. Sometimes I like to go ahead and get my move out of the way if I see that all my confluences are in agreement. And then price came down at 9:30 with momentum, and then it sold. And so we could draw a fib here from this swing high to the next swing low. And price came to this 61.5. And let me zoom in a little bit. Price came to the 61.61, that's 61.8%, and the 50%, and then it sold. It took out that first TP and that second TP. You could have continued to sell this down if you saw something to the left. For me, my goal is to make at least 50 points a day. And with 3 contracts, that is $300. With 8 contracts, that's $400. With 5 contracts, it goes on and on. And so, yeah, this price dropped in 15 minutes. It dropped 130 points. So even with 2 contracts, that was $500 something dollars. With 3 contracts, that was $700 something dollars. And the move didn't take long. Does that help? Does that make sense, ladies?
Yeah.
Okay, awesome. Perfect. It is 7:32, y'all, and I could go on and on about this, but I definitely want to be respectful of time. All right, ladies, I will talk to you all soon. Have a great, blessed rest of your week. And yeah, good night.